Welcome to CoreLogic's housing market update for April 2021. The heat in the housing market intensified last month with our National Home Value Index recording a 2.8% rise. That's the fastest rate of appreciation since October 1988, when values are up 3.2% over the month. These exceptionally strong growth conditions remain broad-based, with values rising by at least 1.5% across each of the capital cities over the month. Sydney led the pack for capital gains, with values surging 3.7% over the month and 6.7% higher over the first quarter of the year. The last time Sydney housing values recorded a quarterly trend this strong was back in June and July of 2015. Following this brief surge, the pace of capital growth rapidly slowed as limits on investor lending kicked in to slow the market. March marked several inflection points across the market. Sydney and Melbourne have now staged a full recovery from earlier downturns. With the acceleration in capital gains across Australia's two largest housing markets, the larger capitals have started to outpace many of the smaller cities that were previously leading the charge in growth. Additionally, for the first time in a year, growth in capital city housing values outpaced the regional markets. CoreLogic's combined capital cities index recorded a 2.8% lift in March, compared with a 2.5% gain seen across the combined regionals index. Housing values in regional areas are 11.4% higher over the past year, demonstrating the higher, earlier and stronger growth trend. Capital city values are now 4.8% higher on an annual basis, with an acceleration in growth evident in March. Victoria was the only state where regional housing values rose at a faster pace than their capital city counterparts. Regional Victorian values were up 2.6% compared with a 2.4% rise across Melbourne over the month. Lower density housing has continued to outpace higher density housing for capital gains. Nationally, house values were 3% higher over the month, while unit values were up a more modest 1.9%. Across the combined capitals, the quarterly rate of growth for houses at 6.5% is more than double that of units at 3.1%. Despite the underperformance, it does look as though unit markets have turned a corner, with Sydney recording 2 consecutive months of rising values, while the Melbourne unit market has seen values consistently rising since October last year, with a trend accelerating over recent months. At the heart of these strong housing market conditions is a disconnect between demand and supply. On the supply side, total advertised listings remained extremely low through March. A count of national total listing numbers over the 4 weeks ending March 28th shows advertised stock levels were 25.5% below the 5-year average. The main reason total listing numbers remain so low is that buyer demand is consistently outweighing new advertised supply. The ratio of sales to new listings is tracking at around 1.1 times, implying for every new listing added to the market, there's 1.1 homes being sold. Such a rapid rate of absorption is keeping overall inventory levels low and adding to a sense of FOMO amongst buyers. The tight market conditions can also be seen in auction clearance rates, which have consistently held above 80% in March. This is also evident through rapid selling times and lower discounting rates for private treaty sales. Housing market conditions seem to be strong pretty much everywhere, but there is some diversity across the cities. Sydney dwelling values are now 2.6% higher than the July 2017 peak, a remarkable recovery considering the 14.9% drop in values through to May 2019 and the further 2.9% fall throughout the COVID downturn. The strong recovery trend can mostly be attributed to houses rather than units, where values are up 10.8% over the past 6 months. Unit values are 1.8% higher over the same period of time and still 2.1% below their 2017 peak. The typical house value rose to slightly more than $1.1 million in March. Home sales are estimated to be 15% higher than a year ago across Sydney, while listing numbers were 15% lower, highlighting the lack of advertised supply relative to demand, which helps to explain the upwards pressure on home values. Melbourne housing values recovered from the 11.1% fall between 2017 and 2019 and the 5.6% drop in values through the worst of the COVID-related downturn to set a new record high for dwelling values in March. The median house value is approximately $860,000, while the median unit value reached $593,000. Local market activity has ramped up over the past 6 months. Over the March quarter, the estimated number of home sales is tracking 17% higher than at the same time last year. This surge in activity is happening across a relatively low supply level, where total listing numbers are only 1.5% higher than a year ago. Across the sub-regions of Melbourne, the Mornington Peninsula stands out with the fastest rate of growth. Housing values across the peninsula were 8.6% higher over the March quarter alone. The pace of capital gains has been accelerating across the Brisbane market since the COVID downturn found a floor in September last year. Local housing values were down 0.9% through the worst of the COVID period and have surged 7% higher over the past 6 months. Like most of the other cities, the unit sector is recording a milder growth rate, with values up 2.8% since September last year, compared with a 7.9% rise in house values. The growth is occurring while advertised supply levels remain 27% below the 5-year average. Against this low supply, the number of home sales is tracking 8% higher through the March quarter than last year. Brisbane inner city house values have led the pace of capital gains, with values up 7.7% through the March quarter. Adelaide recorded a 1.5% lift in home values in March, taking the annual growth rate to 8.6%, well above the combined capitals average of 4.8% growth. The recent trend has been a little softer than other capitals, which could be a sign of earlier market heat starting to cool. The trend in home sales has been easing since December. However, the March quarter recorded sales activity that was estimated to be almost 22% higher than a year ago. Homes are selling in just 41 days, 10 days shorter than a year ago, and discounting rates are around record lows at 3%. The latest data shows an acceleration in growth across premium housing markets. For example, the sub-region of Burnside recorded the highest gains over the March quarter, where house values are up 6.8%. The pace of capital gains has continued to accelerate across Perth, with dwelling values up 1.8% in March, which was the fastest rate of appreciation since September 2006. Such a rapid pace of growth is seeing the market rapidly recover from the 22% peak to trough fall that ran between mid-2014 and mid-2019, followed by a 2.2% drop through COVID. Local housing values are still 15.9% below peak levels, highlighting the relative affordability of the market. The heat in the market is evident from our estimate of home sales over the March quarter, which is up 42% on last year's numbers, while total advertised stock levels are down 23%. Homes are selling in just 27 days on average. That's the fastest rate of sale since 2014. Hobart housing values have continued to rise at a rapid pace. Dwelling values were up 3.3% in March. That was the fastest monthly growth rate since 2003. The long-term strength of the marketplace in Hobart is demonstrated through the 56% rise in housing values over the past 5 years. This is more than double the rate of growth in Sydney and Melbourne. It's also 22 percentage points higher than the capital with the second highest growth rate, which is Canberra, at 34%. Hobart's most affordable quarter of the marketplace has been recording a higher rate of growth relative to the other sectors. However, it's the most expensive end of the marketplace that's accelerating, with the monthly growth rate across the top quartile outpacing the lower quartile in March. The housing trend in Darwin has been extremely strong. Housing values are 11.2% higher over the past 6 months, which is the fastest half-yearly rate of growth of any capital city. Market demand has shifted upwards from a low base in the past 3 months, with the estimated number of home sales tracking 46% higher than a year ago. Meanwhile, advertised supply is 36% lower than a year ago and 42% below the 5-year average. Homes are averaging 47 days to sell, which is the fastest rate of sales since 2010. Despite the strong gains, a recovery to previous highs is still some way off, with Darwin housing values remaining 21.6% below their 2014 peak. Canberra housing values have been rising consistently over the past 20 months. Over recent months, growth rates have accelerated to the highest level since June 1992. House values have shown a much stronger growth rate than units, rising 13.9% over the past year, while unit values are up 5.8%. Sales activity has eased since November last year, though, with the number of homes sold over the March quarter estimated to be 1.8% lower than a year ago. This slowdown in sales could be at least partially related to short supply levels, with the number of listings 31% lower than last year. Overall, housing markets are continuing to respond to a broad range of positive factors, including record low interest rates, and recent economic conditions that have consistently beaten forecasts. In response, Australians are feeling optimistic and confident in making high commitment decisions related to the property market. The upswing in buyer demand has not been met with the same level of increase in inventory. This has resulted in strong selling conditions amidst a palpable sense of urgency amongst buyers, putting upwards pressure on housing prices. While we are expecting housing values to continue rising throughout 2021 and well into next year, it's reasonable to expect the pace of growth will slow. Earlier periods of similar exuberance have previously been quelled by factors such as rising interest rates, weaker economic conditions, or changes to credit availability. As the housing market hits record high values, speculation is mounting as to what will trigger the next downswing phase of the cycle. Short-term interest rates are unlikely to increase anytime soon, and the economic recovery still has some way to go. However, housing affordability constraints, particularly for those who don't own a property, are mounting. There will be substantially less fiscal support going forward for homeowners and potential first home buyers, which will likely contribute to a tapering of demand. This is especially the case amongst first home buyers, where demand has been brought forward by a range of incentives set to end this year. The prospect of tighter credit policies is also on the radar, which we know from previous periods of credit tightening will likely have an immediate dampening effect on housing market activity. The likelihood and timing of any change in credit policies is highly uncertain and largely dependent on a material lift in credit metrics such as debt-to-income ratios, loan-to-income ratios, or higher LVR lending. According to APRA, although each of these metrics rose in the final quarter of 2020, lending standards remain healthy enough to keep any credit intervention at bay for now. As the economy transitions away from fiscal support and housing affordability becomes more challenging for some sectors of the market, it's an important time to keep an eye on the trends. You can keep up to date with all the housing market twists and turns via the CoreLogic research pages at www.corelogic.com.au.